So today we're tackling a really big question. Is the most trusted investment strategy of the last 50 years officially a thing of the past? We're going to dive into why the old rules just don't seem to be working anymore and what some of the world's smartest investors are doing to get ahead of the curve.
Yeah, you heard that right. Experts are calling this a quiet revolution. For decades, there was this one simple recipe for investing that pretty much everyone used. But now it seems like the very foundation of that strategy is starting to crack and the rules of the game are changing fast.
Okay, so to really get what's happening, we've got to go back to the beginning. Let's talk about the reigning champ for all those years, the classic 60-40 portfolio. We need to break down what made it the absolute king of investing for so long.
You know, for generations, this was basically the gold standard. The formula couldn't be simpler. You put 60% of your money into stocks to get that growth, and the other 40% goes into bonds for stability and a little income.
And the logic behind it? It was beautiful, really. Super elegant. Stocks are your engine for growth, right? They give you that long-term upside. And bonds? Well, they're your shock absorbers. And here's the magic ingredient. They were supposed to move in opposite directions. So when the stock market was having a terrible day, your bonds would kind of hold their ground or maybe even go up a bit, cushioning the fall. It made for a much smoother ride.
All right, so if it was so great, what happened? What went wrong? Why is this model that everyone trusted for so long suddenly under fire? And what's making this once safe strategy feel so, well, risky?
Well, the answer really boils down to this huge, fundamental shift in the economy. For decades, we lived in a world of pretty low inflation. And in that environment, that beautiful relationship between stocks and bonds held up perfectly. But guess what? We're not in that world anymore. Inflation is back on the scene, and that relationship, it's pretty much broken. Now we're seeing these scary periods where stocks and bonds are falling at the same time, and that just completely guts the portfolio's main defense.
And that breakdown has left pretty much everyone, from regular investors to the top minds on Wall Street, scrambling. I mean, think about it. If your go-to shield is broken, what do? Where do you go for protection? It's kicked off this massive hunt for new tools to build a portfolio that can actually withstand these new challenges.
Well, out of all that searching, a new contender has stepped into the ring. One of the most popular solutions that's emerging involves a pretty simple but really powerful tweak to that classic formula.
So let's meet the 60-20-20 portfolio. Big players, we're talking major firms like Morgan Stanley, are floating this new idea. You keep your 60% in stocks, but you chop your bond allocation in half, down to 20%, and then you fill that other 20% with gold.
And listen, this is not just some academic theory. Not at all. Investors are really voting with their dollars here. I mean, we're talking about a flood of money, $10 billion flowing into gold funds in just 1 month. People are actively re-engineering their portfolios for this new world.
So why gold? This part is actually pretty fascinating. You see, it's viewed as the only liquid asset out there that isn't also somebody else's debt. It's not just a piece of paper, a promise from some government or bank. This means it kind of exists outside that whole system, which makes it a hedge against not just market risk, but political risk too.
But hold on, it's not just about swapping some bonds for gold. Oh no. Some of the smartest, most sophisticated investors in the world, I'm talking about the massive endowments at places like Yale and Harvard, they're doing something even more radical.
They call it the endowment model, and it was pioneered by the absolute legend David Swensen at Yale. And the core idea? It's pretty out there. They move huge chunks of their money out of regular stocks and bonds and into what they call alternative assets. So think private companies, venture capital, big real estate projects, stuff you can't just buy and sell with a click.
Now, the logic here is really compelling. The whole idea is to capture what they call an illiquidity premium. And what does that mean? It's simple. You get paid a bonus for being patient. By locking up your money in these private markets for longer, you've historically been rewarded with much higher returns than you'd get from the public stock market.
Okay, but here's the catch, and it is a huge one. In these private markets, who you invest with matters, like a lot. Just look at this data. It's absolutely stunning. The difference between the top-performing fund managers and the bottom ones is gigantic. It's way, way bigger than anything you'd see with public stocks. Picking the right person to manage your money isn't just important, it's basically everything.
I mean, this just completely flips one of the oldest rules of investing right on its head. You know that old saying that your mix of stocks and bonds, your asset allocation, determines something like 90% of your success? Well, in this new world, in an endowment-style portfolio, that number might be as low as 40%. The rest all comes down to picking winners.
Okay, so we've covered what you might own, right? Things like gold, private equity, but a truly modern strategy goes even deeper. It's also about how you own it. It's about rethinking the entire philosophy of how you put a portfolio together.
And that brings us to a really intuitive idea called goals-based investing. So instead of asking, hey, did my portfolio beat the market this year? The question becomes, am I on track to pay for my kids' college? Am I going to be okay in retirement? It's a really powerful mental shift because it connects your investments directly to your actual life goals.
And for the final layer, let's talk about a really powerful pro-level strategy. It's called asset location, not allocation, location. The idea here is to be really smart about taxes. You put the investments that kick off a lot of taxes, like some types of bonds, inside tax-sheltered accounts, like your 401k or IRA. It's one of those pro-level tweaks that might sound small, but over a lifetime, it can make an absolutely massive difference to your bottom line. So you see, that quiet revolution we talked about? It's definitely getting louder. The breakdown of the good old 60-40 isn't just some passing trend. It feels like a real, fundamental shift, and it's forcing every single investor to take a hard look in the mirror. And it really leaves all of us with one big, critical question to think about. Is your portfolio built for the world we used to live in, or is it ready for the one that's coming?